We're back. Hey, Dave.
Hey, Zach.
We are in our new studio that we set up. Kind of fun.
Yeah, welcome to Black Diamond Mortgage Studios. Today is a dream meeting, and what we want to talk about today is getting ready for the mortgage approval. Whether you're serious about going in and applying for a mortgage or not, there's some real basic stuff that will take the fear out of going to see the mortgage professional, or the fear out of whether you're going to get a guaranteed mortgage approval or not.
It's going to be fun.
Yeah, so a lot of people will simply not go visit a mortgage professional on the fear piece, or on the assumption that they know something's going to go wrong, and so they'll take inaction. And so there's basically a very simple way of analyzing mortgages that's used by all lenders. And so I wanted to just run through that and to give folks a few tools so that if they're not ready to talk to a mortgage professional, they can still self-diagnose their approval capability. And then maybe that self-diagnosis will help them actually just get in and get started. So that's what today's about, Zach. Any comments before we jump in?
No, the only thing I would say is just that I had a similar fear when we bought our first house. It's very common to be concerned about the possibility of failure. So ideally, we help dispel that myth, provide some tools, and help people out, because fear is just not a fun way to live life.
Yeah, actually at Black Diamond Mortgage, we've been showing our home ownership stories. And if you hop onto our YouTube channel, in fact, please subscribe to our YouTube channel. You'll see content as we put it out. All of our employees are telling their homeownership story. And in mine, I talk about the fact that I had no idea that I could buy a house, and a mortgage professional suggested that I try. And I kind of put my hat in the ring expecting nothing to happen. I ended up buying a house very shortly after that because it was a lot different than what I expected.
Yeah, those stories are a lot of fun because the main theme through all of them is exactly that. There's a confusion piece for people that goes with buying a house. And so I think it's just normal. It's the way people are.
So when you're getting ready to buy a house, or you're getting ready to get a mortgage approval, you can be in two different camps. You can be in the I've never owned a house, or you can be in the camp of I own a house. Can I buy another house? And it's always going to come down to the same thing. Lenders are going to analyze basically three major components of you, or you and your stuff, to see whether you can handle a mortgage or not. And so we're going to break that down today and just kind of help you self-diagnose. And so I'm going to tell you what they are. So basically, I was surprised when I learned to be a mortgage broker that there were only three things that I needed to know. Because, I don't know, Zach, would you say there's like 1 million things that we encounter on a daily basis?
2 million?
Yeah.
Yeah.
There's just manuals, like thousands and thousands of pages of information. And it still applies. I'm going to tell you the three things. And then the thousands and thousands of pages are little details that do matter. But it doesn't overrule the three things. The three things are still basically what it all comes down to. So the three things are, I'm going to write them on this little board here. The 3 C's. So, yeah, it's that simple, the 3 C's. So I'm going to write them down for you, and I'm going to write them in a triangle. So I'm going to make a triangle. And one of them is credit. One of them is cash flow. And one of them is collateral. And those last two words, and I might have even spelled collateral wrong. So here's your triangle. And you can see credit, cash flow, collateral. And I did it in a triangle for a reason. In geometry class, you'll remember, the triangle is 3 connected pieces. And so these pieces are connected. They don't always work out to be a perfect triangle. Sometimes the triangle is weighted a little more heavily to one than the other, but it's still a triangle. You have three. So you might have a really skinny section of the triangle and a fat section. That's okay. You need a triangle. So in other words, the lender is going to make sure that they have all three pieces connected somehow. And that's how you get the approval. So you can't have an approval unless you have some degree of success in these three areas, or the lender is willing to override one of the three because of the amazing other two. Generally, I don't think you can ever get a loan on just one for the most part. There'll be exceptions to everything that we talk about today. And so with that, you have your credit, cash flow, and collateral. I'm just going to quickly make the two words. Everybody knows what credit is. Zach, what's credit?
Credit is, the way I like to describe it is it's your grade school report card on how well you handle items that you are responsible to pay. So things like credit cards, student loans, car loans, anything that has a required payment and the history, so going backward on how you've done handling that.
And then they give you a credit score, which that's the part. I think everybody knows there's a thing called a credit score, and that if you go in to apply for credit, they're going to look at the credit score. So that is a big piece. Heads up, if you don't have a credit score, it doesn't mean you don't have credit, and it doesn't mean you can't get a loan. It just means there's not an easy way to figure out what your credit's like. So the lender can go figure it out another way.
So in using the no credit as an example, the triangle gets a little bit shaped differently because it's weighted more toward the credit being an important aspect.
It becomes more important because we can't see a credit score.
Right.
Yeah.
Right.
So the other two, those are the words everybody can't quite handle. So I'm actually going to give you a substitute word to make it easier. But because the 3 C's is easy to remember, we call it the 3 C's. So cash flow. Let's substitute cash flow with income. Mm-hmm. And then the other one, which is collateral, that's basically the house and or the down payment. And so when you're buying a house, that's either the down payment or it's the value of the house, but it's anything related to the money that's either going to be paid toward the house or the value of the house, because the lender gets the collateral if you don't pay the mortgage back. And so it's important. And but a lot of people are like, what do I focus on? I don't even own a house yet. So then focus on whether you're going to make a down payment or not. And guess what, Zach?
What?
You might not have to make a down payment.
I didn't.
So you might be able to have a zero collateral starting point, and you still have this triangle, and it might be able to stand because it's getting at least analyzed by the lender. There's some, they're going to do an appraisal. They're going to figure out what the house is worth. And so there is a house. If you didn't pay anything to start getting it, the lender still gets access to it. So it's still part of the triangle.
Yep.
That's good to know, because a lot of people are thinking, well, I don't have anything yet. And so that's common, actually, and that's why we want to do this, is so we can start to get a house.
One of the analogies that you just reminded me of is I come from somewhat of a manufacturing background, and so there's a similar triangle that is in play there, where you have basically in your triangle, you've got quality, schedule, and cost, right? And so there's just a very similar, you oftentimes can get 2, but it's very, very challenging to get 3. So that's kind of what you're mentioning here too, is we want to focus on all 3, but there are opportunities to actually analyze 2 of the 3 with a heavier weight, if you will, than all 3 together. Is that an analogy that's comparable enough?
Sure. I mean, I've never worked there, but I'm gonna give you credit for a great example.
Credit. That's one of the 3 C's. Thank you.
Your credit went up.
Yeah, score going up.
One of the things, this is a dream meeting. So if you've made it this far through the video, you know, what do we want to get out of this? Like, I want you to dream about getting approved or the next purchase or whatever. And one thing we're going to offer you, so you can check back with Black Diamond Mortgage anytime you want. We have a free tool that we will give you, and it's basically it's an app for your phone, or you can log into it on your regular computer. You can track all this stuff without Black Diamond Mortgage, and it'll show you where you are currently with your credit. If you own a home, it'll show you the value of the home. And if you're trying to work on your income, it'll show you generally how we look at your income. And so that's going to be a free gift. All you got to do to reach out and ask for it. We call it the FinLocker, but you can just ask for the app that helps you plan to get a mortgage. And the idea is for you to be able to do things before you apply to get ready. And so if you have done nothing or you're scared and you don't want to deal with us, but you do want to work on it, we want to give you our mortgage prep app. And it's we're not going to try to sell you stuff. We're not going to give the information to anybody else. It's just for you. But the cool thing is you can see your own credit score. And so if you already know it's bad, that's okay. And so we're going to talk about that being one of the first of the 3 C's. So we're going to talk about credit score just a little bit. So I'm going to write a couple numbers down here. But I'm going to write no credit. And then I'm going to write poor credit, but possibly good enough. And so that's going to be, we're going to call that the 580 zone, if you know your score. And then we're going to go acceptable credit. And we're going to call that 640. So if your score is a 640, you're going to be called acceptable. And then we're going to call good or great. And basically, we're going to say if you're in the 700s plus. And so I'll shine this up with the camera here. But basically, you got your no credit. You got your poor credit, but maybe a loan. And then you got your acceptable credit, and you got your good credit. So when you know your credit, you can start to think about, can I buy a house? You know. And so with no credit, the most important thing is it no credit because you literally do not deal with anybody on a computer basis or where they just don't see you? That can be the best form of no credit. Mm-hmm. What we would end up needing to do is just find out if you can pay a rent payment or if you can pay other bills that just don't show up in the credit scoring system. And you can actually be generally eligible to get a halfway decent mortgage with no credit. On the other side, if you have no credit, but when you did have it at one time, you did a really bad job, then that's going to be different. So then in that case, we need to go back and see if we can start putting some good credit on the scoreboard. There will be things that show up even with a no credit score. Sometimes it's reflective of your past because they keep track of 10 years at least worth of data on these credit reports.
What are some of the ways that credit is analyzed? What do people need to look at? Let's say they're in the poor credit category and they're trying to get to the good or the great. What are some tips or tricks that they can utilize to improve their score? Yeah,
sure. So basically, let's just step back and talk about a major, just general loan principle anyway. So the lender is looking at factors like your stability as a person.
Right.
So when we look at the income and the credit, stability is a factor. And then trends. So is it getting better or is it getting worse? Same, we're going to do that with the income, and we're going to do that. And believe it or not, they even do it with the collateral. They'll look, and if the market's on a major decline, then just because it hits an appraisal a certain number, if everything's cratering down, they might analyze it hey, we know it's going down. So they look at everything on stability and the trend. So with your credit, that's part of it. So stability, how do you get stability? Well, you want more of good stuff and less of bad stuff. So if you have not very much credit, the tactic is to get a little bit more credit and to have it be good credit. Not going to do you any good to run out and get some credit and then miss a payment. Especially the less credit you have, the more horrible it looks if you miss a payment. If you've been paying your bills for 50 years and you miss one credit card payment, you're still going to have a pretty good score because there's so much information that says you're good. But if you hardly ever do anything and you miss a payment, then it looks a lot worse because we don't know that much about you. And so that's kind of how credit works. So generally, there's a couple things, and when we get into the weeds on it, they look at like how much do you owe other creditors, and do you have any buffer? So in other words, it's better to have a little bit of credit left than to be using all of your credit. And then having time in the credit environment helps you. The longer you've been using credit, the better. And then just obviously paying your bills on time.
I think about coming back to the analogy of the grade school report card. And this fits directly with what you're saying, because if you think about when you were in high school or college or whatever, the very first test of the year, you don't have any history. So if you fail that first test or you get a D in that first test, that's your grade in that class. Now, if you've got a history all throughout a semester of getting A's and B's, and then you have a rough time at the end, it's fitting into what you mentioned about having 50 years of good payment history, well, then that's not going to have such a drastic effect on your overall score within that particular class. So just an analogy to use to kind of think about why the time is important and how to handle specifically that early on portion of credit and why it's so critical to your score.
Now, just to make it kind of simple, if you're trying to buy a home or you're going to go see a mortgage professional and you're self-diagnosing, and there's those 4 credit categories I listed. There's a 5th one that I didn't list, and that's called I throw my mail away and I don't care about credit. You're not going to get a mortgage. So when you're below these standards that I mentioned, we want to help you, but you're not ready. And so you'll need to do something. You'll have to start taking credit seriously as like step number 1. And then you want to work yourself into one of these categories. And we can help, or you can help yourself. I'm only talking about categories you can get a loan. So one thing I want you to think about is if you're in the first 3 categories that I mentioned, which was the no credit, poor credit, which is like 580 but maybe lendable, and then acceptable credit, which is around 640 to 680. If you're in those 3, one thing to know is you're more likely to get an approval for your first house. You're less likely to get approval for like a second house. And also, you're not as likely to get $1 million loan. You're more likely just to get a loan to get you a house. And the reason is the government's created a lot of cool programs, and there's also some lenders, even outside the government, that have created some programs that basically want to help people get a house. And so they're not trying to help you get a $2 million mansion. They're just trying to help you enter the game. Usually people that get a home loan become more responsible after this happens. You know.
Yep, absolutely.
So with credit, you're going to pick on the prep to get ready for a mortgage, you're going to pick a reasonable goal and try to attain it. So if you have no house and you're currently, I mentioned that poor credit, but we could maybe work with you, is 580. If you have a 570, you're almost there. So we need to try to get you up 10 points and show you a loan that you can get. And so that's like something you can work on. And then you can probably buy a house. And then down the road, your credit's going to get way better. And if you do everything right over time, you'll have a between 700 and 800 score. But initially, you got to get started somewhere.
Yeah, I think that that specifically in that range that you're talking about, there's a lot of people that know how to help analyze a credit report too. So I think that if you were able to have somebody take a look and maybe you're confused on what it looks like, the free tool Dave mentioned, FinLocker, is helpful, but you also sometimes need somebody who understands how credit works. And so I think if you're sitting at that 570 and you want to bump up a few points, it doesn't take that long most likely, but it does have to be strategic. So keep that in mind as you go through the credit improvement process.
So that's all we're going to talk about credit today. We'd probably do a whole show on credit someday, maybe 6 shows. But the point is that you need to know your credit and you need to work on it unless it's perfect. If it's not perfect, you should work on it. It's always going to come up. No matter how many homes you buy, I've dealt with a lot of borrowers that are just getting into the game and they find out their credit's not that good and they fix it and then they buy a house. It always fascinates me, but I even deal with a lot of clients that have just generally, they have a lot of money, they have a lot of homes, and they go to get another home and they just struggle a little bit with credit. And so even they need to work on it a little bit, so it's kind of like anything else in our life, like working out. And if you need to always kind of keep an eye on it and do a good job. But if you don't, it's going to creep in and affect things in a negative way.
It's called credit maintenance. Right?
Credit maintenance. Yeah. Just always work on it. Yeah. Keep your car maintained, keep your credit maintained. So with our app, you can do it. You can look and see how you're doing. Yep. They actually have a tool on there that is, what if I do this one thing, what will it do to my score? Kind of fun to play with, like I'm going to maybe pay this one bill off. Is it going to make my score better? And you can check and see. All right, so that's one of the 3 C's, credit. We're hopping over to cash flow, income. This is the other big one that you can control. So I'm going to just hold up a big number here. 43%. Okay, so what is that? Well, first of all, it's not a rule. So I just held up 43%, and you and I, Zach, can talk about deals we've done where this number is 60%. So not the 100% rule, but it's a good rule. It's if you have no knowledge of anything and you're going to try to get ready for a home purchase, 43 is a good number. So what is 43%? It's the debt to income ratio. So maybe, Zach, give us a quick, what is a debt to income ratio?
You bet. Sometimes you'll hear it abbreviated as DTI. So if you hear that acronym, it stands for debt to income. The easy way to do it is it's a ratio. So it's a mathematical equation. And the total way that it works is you're going to take your total income, right? So what you make, and traditionally it's analyzed on a monthly basis. So you can take a salary and divide it by 12, or you could take your hourly income and multiply it out by how many hours you work to figure out your monthly income. And then, so that's the latter half of the equation. And then the first part is anything that you have a payment that you owe money to. So if you have a car loan, whatever that amount that you owe monthly, that plus revolving debt on credit cards, plus student loans, etc., plus the expected housing payment that would come from the loan that you're looking to obtain, all those components get divided into that monthly income. And that's how you end up with a ratio. And ideally, that ratio, that percentage, is, as Dave mentioned, around that 43%. But again, there are a lot of exceptions to that as well.
That sounded confusing, but it was totally accurate. And I understand why you did it that way. So let's just say it's really confusing. You're like, yeah, that's, how am I going to figure that out? Well, if it's way over your head, you can go ahead and talk to your mortgage professional. We'll give you that number. Where is your number? What if you want to self-figure it out? So I'm going to give you the easy way, and then it's always going to be a little bit more complicated. But so we're going to just do quick math. I apologize to everybody who hates math, but we're going to try to make it as easy as possible. So, Zach, here's your scenario. Family, husband and wife, they make $10,000 a month. And after they buy a house and they have a car with a loan and they have a couple credit cards, one of the credit cards was because of that right there. You see that?
Trip to...
They went to the Caribbean. And they put it on their credit card. And so, but there's a minimum payment. So you got the trip to the Caribbean, the car, and a house. They make $10,000 a month, and it turns out that they owe everybody in this environment $4,300 a month in order to keep the minimum payment made and to have good credit. What is their debt to income ratio?
Well, what is 4,300 divided into 10,000? 43.
Oh, 43. So they are pegged
yes.
at the safe zone, the top end. So that's, you divide the monthly debt payment into the income.
Right.
So basically, if you can add up the debts that show up on your credit report, is the easiest way to look at it. There's other things, but keeping it easy. We're looking at what liabilities show up that everybody can see. And then we divide it into your income. That's your debt to income ratio. So if you're self-diagnosing, then you're if you can come in at 43%, almost every loan works for you. And then the cool thing is if you come in at 50 and you really want a house, there might be a loan option that exists out there for you. But now you got to talk to the mortgage professional because not every loan is cool with that. The government actually, after the 2008 housing crisis, picked the number 43 as the acceptable number, and then they exempted all their own loan programs. So, because, the government, they create a rule, and then they go, that rule is hard to live by, so we're not going to live by it.
That rule sucks.
Yeah. So good. If you're in the government, the cool thing is you can create rules for everybody, and then you can actually say, but we're not going to follow that rule. So, hey, that's the world that we live in. So 43, everybody that offers loans can offer that and be legal with the government's expectation of what a reasonable payment is. And then if you want to go higher, there's cool loans out there that the government actually allows you to go higher, and there's reasons why they do and don't. So once you're getting into that zone, if you need it, you can talk about it with a mortgage lender, see if it works for you. But if you're under that, you're going to look really good, and most loans are going to be acceptable. So that's a good target on income. Cash flow, the second of the 3 C's.
Honestly, I like how you mentioned that because you simplify it in a way that it's actually not that hard to analyze. But it is probably one of the most important parts of a loan approval. So, Dave,
you're
writing something.
That's right. So we're gonna hit
What's next?
We're gonna hit the third, the collateral, but we're just gonna talk about down payment for a second. So here's the 3 numbers: 0, 3, and 5%. Okay. So what does that mean? So you're preparing to buy a home, and if it's your first home and you don't have a lot of money saved up, please keep in mind that if you have a lot of money saved up, then if your dad or your grandfather told you to put 20% down and you have it, it's probably still the best thing to do. Nothing has changed. However, there are a lot of options, and even that advice should be looked at with a couple options. But let's say you're trying to buy your first house, you're trying to get there, and so you got your credit relatively acceptable. You've calculated that you can make a reasonable debt load. You've done the cash flow analysis, and maybe you've met with a lender and you're under that 43%. And now you're like, I just need the third thing. I just need the down payment. Well, one of the numbers on the board is 0, so you might be ready to buy right now. So there are a couple of programs out there where the down payment requirement is essentially waived. Some cool ones are if you're a veteran and you served our country, they've made the down payment the least important part. They basically took that. The veteran almost gets a 2 C's loan approval.
Yes.
Everybody else got 3, veterans get 2. Well, you served our country, you deserve it. So they have a no penalty for 0 down loan option. And there's a couple available for non-military that you can talk about with a mortgage lender. There's restrictions on all these programs. Mm-hmm. So if you're going to head into that environment, you're going to need to make sure that you're eligible for the right reasons. But the cool thing is if you're doing the things you need to do and you got the credit and the cash flow, you might be in the door already. But let's say that you find out you're not eligible for those options. It's not too much money. So we move over to the next one, which is the 3. And I'm going to say 3 actually is 3 or 3.5. There's a couple programs that are widely used that are at 3.5%, and there's a few that are at 3%. But the general idea is a lot of loans exist where the minimum down payment entry is 3 or 3.5% of the purchase price. And the cool thing is one of them is the one that targets that poor credit but still eligible category. That's through the FHA. And the VA also likes to help people in that lower end credit category. But if you're in the 580 and you're like been told no by a lot of lenders and you thought you couldn't get a loan, the reality is the FHA is considers a 580 to be good enough. Mm-hmm. And they're a 3.5% down loan program. So, Zach, I'm going to put you on the spot. Let's do a little math here. Brace yourself. I want to buy a $400,000 house, which is let's go $500,000. The market's brutal out there after 2021. So you're going to buy a $500,000 house. And
15,000.
Yeah, 15,000 is about how much money you got to come up with, right?
3%.
Okay, 3%, and then 3.5% takes it up a little closer to 20, right?
Nice. Yeah.
15 to 20,000 will get
It's
you.
in that range.
It's in there, yeah. So that's what you're looking at. If you're making 10,000 a month, which a lot of families are making, you need 2 months' wages, 2 months' salary, and then you're in. Sometimes you can rearrange things to make that not that difficult to accomplish. You can also get gifts on most of these programs from family members, and so and then if for some reason you don't fit the mold of what lenders consider helping a first-time home buyer, then the worst-case scenario is the 5% down for that first home purchase. That's under $700,000 or $800,000. You can basically buy a house with 5% down. And so on the collateral piece or the down payment piece, you got to have a little bit of money, but not very much. What do you think of that, Zach?
I think it's good. I think that it's important for a lot of young families to understand these details because of the myths that have existed for a while. If you listen to our homeownership stories, one of the Maria Phelps, she's an owner here at Black Diamond. She mentions that if you put your mind to it, it's really not that hard to save that money. And I don't mean to downplay it and make it sound simpler than it is, because it absolutely is hard. There are things in your life that you have to cut out. But it doesn't take that long to get to those numbers. And so that's why I think if you think about that triangle, the collateral is possibly the easier of the three because of the amount of time that it takes to solve that sector of the triangle. The other two are really based in history. And so you can have some things that you drag along with you that take some time to unwind. But the collateral piece is doable if you're willing to do the hard work.
Yeah, and then if you happen to luck out and fit in the zero category,
or maybe you have a rich uncle.
You get a pass. A rich uncle. Yeah. Rich uncles are the best. Well, hey, we're going to start to wrap it up. We're going to do a couple quick things, but I want to remind you that especially if you've made it this far through the video, first of all, if you made it this far, can we just give him a round of applause, Zach? On the digital board, yeah. Yeah.
We appreciate you.
You're probably going to get approved for a loan just because you could do that, But
patience.
But I want to remind you. So if you're like, I don't want to deal with anybody, maybe just check out Ask Us for the free app, and everything we just talked about you can do yourself, and just to get ready. And then it's actually the app's designed where you can just hand it over to a mortgage lender. So if you put some stuff in there, you can actually convert it to a loan application. So it's super slick. Just designed to keep you from being afraid to try, I guess. So I'm going to try a little experiment, Zach. So some people say that if you don't have very good credit, you can't buy a house. So we talked about some things today. Is that a true statement?
I learned a lot from you, Dave, and I would say the answer is no.
So find out what your credit is and start getting ready to buy a house.
Yes.
It's if there's some stuff to work on, it can be worked on, but it's not, the lenders are not denying everybody with bad credit.
And something that's important too is because it can take time, if you want to buy next year, you might need to start looking at credit now, right? And if there were some things in there. So
yeah. Start working. All right. So that's off the table. There is I'm going to skip that one, but let's just say you have to have 20% down to buy a house. Have you heard people say that before, Zach?
Many.
So is the answer, like, do you have to have a lot of money saved up in order to buy a house?
No.
So that's awesome. So I hope you got that out of today's class is if you have a desire to buy a house and you're willing to do the basic things that need to be looked at to see if you can pay the mortgage back, you're probably going to be able to buy a house.
I agree. So what do you say for people that are concerned about prices where they are? Does that matter at all?
What I would say is whatever the prices are, there is a number that you can afford. and somewhere there's a house that you can buy. And I know sometimes, I'll give you like an extreme example so that we don't have to get into the weeds, but I love to ski. And if I went and got approved for a mortgage and I had a regular job, was doing regular things, I probably wouldn't get approved to buy a house in Aspen, Colorado, because the houses are really expensive there. But in the state of Colorado, there is a place where I could probably buy a house. And maybe it's not even that far from Aspen, Colorado. So one of the things is find out what you can afford and then cast a net and see where can you afford, and then start looking at your whole life and say, do I want to do the work to buy a house in Aspen first, or do I want to take the work that I've done and buy a house, and then maybe later when I become more successful, I'll move to Aspen, But it's good to know where you're at. And so I've found that buying a home, the number one thing you got to do is start. In my home ownership story, I was actually hitchhiking up Big Mountain to go skiing. I was newlywed. I had just a job at a tire store. I did not consider myself to be ready to buy a home, but I met a mortgage broker, and you know how mortgage brokers get paid?
I do.
They sell a mortgage and they get paid. So he sees me as a human being with a pulse.
And a job.
And he asks me if I have a job, and I say I have a job. He's like, ooh. And he's like, yeah, well, here's your number. Well, it turned out the number was I could buy a house, and I didn't even think I could buy a house.
Yeah.
So I was glad that he took the interest in me to just help me do what the 3 C's. He took my income. He saw that I had no down payment, but he was able to give me my where am I at diagnosis, and I still didn't want to buy a house after that, Zach, but I gave the information to my wife. She wanted to buy a house. And so we bought a house.
I think something that's important on your story too, because that is one of the biggest things I hear is we talk to folks and we get through the 3 C's and we've got an amount that makes sense. And the concern is that there's only 1 or 2 homes available at that price point. Dave, how many homes were available at the price point you were approved for when you bought your first house?
Yeah, so when we were approved, there were 2. In fact,
in where? In the whole valley?
In the town that we wanted to buy in. I think if we had cast a wider net, we would have got more. But this is a funny thing I thought of is, so we went to a realtor, and I told them the number that we were approved for, and the first realtor kind of looked down and was like, oh, great. But I was like, fine, I don't care if I buy a house. My wife wanted to buy a house, so she went to another realtor, and they pulled every listing, and there were 2 on the list. And so she's like, we're going to go look at those 2. Well, we fell in love with one of them. Yeah.
There you go.
Totally unexpected, and it's what you should do when it's, when you're ready to do this stuff. Like it only time is only working as an enemy of yours if you're not getting going on this journey of trying to buy a house, because the sooner you do it and the sooner you succeed at it, the wealthier you're going to become. And so there's always going to be things to put this off. And I recommend just, attacking it with whatever level of effort that you can throw at it, and then allowing it to start to come together for you.
So get the 3 C's in order, cast a net, and go for it. Is that a good summary?
Absolutely. And then do know that when you work with a great mortgage professional, obviously we'd love to work with you. But most mortgage professionals are happy to be with you on this journey. Mm-hmm. If you're afraid, I wanted to give you this journey in a way that you could do it yourself. But it's a relationship business. Get with somebody that you like and that you are willing to do the journey with, because I did break it down to 3 simple things. There are a bunch of little dumb, little complicated things. So once you can pick somebody that you want to go on the journey with, they'll make sure that one of the little dumb complicated things doesn't get in the way of the 3 easy things. And so definitely don't assume that there won't be something that you need to do that's slightly more complicated. But if you've done the analysis of the 3 C's, the reality is if you're in the zone, then you're close enough that you should be starting.
Love it. Cool. Any final parting comments for our audience?
If you like this video, take a look at the Black Diamond Mortgage YouTube channel. We have a lot of videos, and we would love to hear if there's a topic that you want a video about. And we're going to keep producing these on and on. So if you subscribe, you'll get notifications and you can peek. And what we also want you to do is we want you to share this with somebody. So if you have learned this and you're like, yeah, I didn't really need that, I just wanted to know what they were going to talk about. Well, I guarantee you know somebody that does need to know it, and they can watch this video without the pressure of somebody trying to sell them anything. So feel free to share this with anybody.
Awesome. Thank you, Dave. Thanks for watching.